So this is kind of a subset of the Federal Reserve. This is how monetary policy, we're going to start talking about how monetary policy is carried out and what it means and what it looks like on the graph. So first I just want to introduce the money market graph so that you guys kind of understand what we're looking at here. And then we're going to go back and talk about T accounts and buying and selling of bonds. All right, so first question. All right, so what is interest? What is interest? Yeah, like what is interest?
Cost of borrowing money.
Good. It's the cost, or let's say it's the price of borrowing money. Okay, the price of borrowing money. So interest is the price of borrowing money. So we're talking about the money supply graph. We're going to talk about interest. Remember that I told you guys on any graph, the price of something is always on the y-axis. At least in this class, the price of anything is always on the y. So in the money market graph, all right, your interest rate is going to be up on the y-axis. Now, it's important for you guys to understand that as a reader and a grader during the AP test, that we're looking for specific things that you have to have labeled in order to get the points on the graph. On the money market graph, this is one of them. We're looking for on the y-axis that you have interest rate labeled. Now, you can kind of tell, but the y-axis or interest is just lowercase I. You can write out interest rate if you want, and that would be fine too. But lowercase I serves as interest. You're going to get the full credit for that. On the bottom, remember that on the x-axis is always going to be the quantity of something. And that's no different whether we're talking the money supply graph or the ag demand, ag supply graph, right? Real GDP is just the total amount of goods and services produced in that country in a year. It's all real GDP, so it's the total quantity of goods and services produced. In the money market graph, we're talking about the quantity of money. Quantity of money. So if you put Q sub M, you're going to be just fine with that. So Q sub M. I wouldn't use the dollar sign, and the only reason why I'd say that is because in the foreign exchange market, you're going to be using that kind of stuff. So I just don't want you guys to get confused. So probably Q sub M is better. Plus, I've seen AP exams that don't use the United States as their country as they're asking this. They'll either say like country A, or they give you some fake name for a country, and so you can't assume dollar sign. And I'm not 100% sure that they would give you that, but if you just labeled it Q, I don't know. I'd have to look and see what the grading rubric for that year is. But Q sub M, they'll always give you. All right, the next thing that you want to make sure that you have is what we call a perfectly inelastic line, which means that it's straight up and straight down. Now, you haven't learned that yet because we haven't done micro yet, but anything that's a straight up, straight down line or a vertical line is going to be called perfectly inelastic. And that's going to be the supply of money, S sub M, your supply of money. Now, this is a really important point that I'm going to really emphasize kind of throughout now the class. Who is the only entity that can produce money? The Federal Reserve, good. They're the only entity that can, the federal government, the Fed, I guess the Fed itself doesn't produce money. They have to put in for it. But the Fed is the only one who can affect the money supply. That is incredibly important. However, remember back to your problem set, maybe it was last week, that talked about the money multiplier. Right? When banks loan out money, do they create money? Sort of. The answer is sort of. This is where it gets confusing. Yeah, you gotta love an economist, right? Sort of things kind of happen, right? So they kind of create money in that the money that you've put into the bank, they loan out, and that money then gets spent through a multiplier, right? And it either gets put back into another bank, usually, and then that bank loans that money out, and then they put that, and so on and so forth. So it does create that kind of money. But does the pot of money, your overall money base, the monetary base is what they call it, does that change? Or is the money that, let's say, you get a $1,000 check from grandma because of your confirmation or baptism or whatever the case, or you can call up your grandma and be like, yo, grandma, I need $1,000. If that's the case, tell your grandma, like, I would like some money, and you can just ask for it from me. But if you go and you deposit $1,000 from your grandmother, are you changing the monetary base? Are you changing the pot of money that actually exists in the U.S. economy? No, you're not. So you're not like creating the new monetary base. So that supply of money can only be affected by the Federal Reserve. So the econ way of saying it is monetary base. The way that people actually understand it, and the way I think of it, it's like the Federal Reserve is a leprechaun at the end of the rainbow, and there is a pot of money. And only that leprechaun can put more money into that pot. Okay, so when we're talking about the supply of money, we're talking about that monetary base, that pot of money. Now, on the FRQs, they always try. If you've got a money supply question, they always try to trip you up. Remember, if you're taking money that already exists and you deposit it in a bank, you have to subtract that initial deposit because that money's already been in the economy. If it's the Federal Reserve buying bonds, then you don't have to subtract that. So I would like put that in your notes somewhere in the margin or up top or something. I'll repeat it, and I would circle it because they always try to trick you on that. There will be multiple choice questions that try to trick you, and if you have an FRQ on this, they will absolutely try to trick you. So let me reiterate that. All right, if it's money that already existed, like you're depositing a check. Bless you. The monetary base, or actual money supply, does not change. So if it's a check you're depositing, the monetary base, or the actual money supply, does not change. Which means if you're asked how much that money multiplies out, bless you, you've got to subtract that initial deposit. Which means that if they ask how much the money supply changes, and it'll depend, I shouldn't use that term, money supply. If they ask you how much that demand deposit actually changed, you've got to subtract that initial amount of money out. So if it's grandma, she gives you $1,000, and let's say it multiplies out to $10,000, you've got to subtract that $1,000 out and say it essentially multiplied $9,000. Does that make sense to everybody? If it's the Fed, through buying of bonds, that changes the money supply, then no subtraction is needed. If it's the Federal Reserve through the buying of bonds, that changes the money supply. No subtraction is needed. It's the Fed through buying of bonds that changes the money supply. No subtraction is needed. Again, I absolutely guarantee on the test that you're going to take next week, next Friday, and also on the AP exam, if it's not an FRQ, it's going to be in a multiple choice. But they are going to try to trick you into that, and it's not even tricky. It's making sure, checking to make sure you understand who affects the supply of money. You guys all got it right. You guys all correctly said the Fed. But when you get on the AP exam and it says Joe goes and makes an $1,000 deposit, then a lot of people forget to subtract that initial deposit out. Okay, that money is only multiplying. Joe didn't, and if Joe printed money in his basement and went and deposited that, he's going to have a big problem with the Secret Service. And the AP test doesn't do that. It says, now assume you can print your own money. I've never seen a question like that. That'd be a really good, tricky one, because everybody always teaches, so only the Fed can manipulate the money supply. But if they were like, now all of a sudden you can print your own money and go deposit that in the bank, then you wouldn't have to subtract that money out because it's brand new. But don't worry about that. I don't see them as doing that. Yeah, I know. See, I could make you put a mean test. Yeah.
So once your money from grandma multiplies to $10,000, $20,000, that $9,000, does that count as the money supply growing, or since the Fed can only control the money supply?
So it's not the monetary base that's correct.
It's not the monetary base. It's monies.
It's money being multiplied, that deposit being multiplied out. Okay, good question. All right. Now, I talked about in the very beginning that the money supply, in this case, the supply of money, to use the right vocabulary, is straight up and straight down, meaning that interest rates, right, don't really affect the money supply. In other words, as interest rates grow, the monetary base, the amount of money that's in that pot of gold doesn't change. Okay, so whether the interest rate is like 0.5% or it's 50%, that monetary base doesn't change. Because remember, going down your x-axis here, this is your quantity right here. Okay, so remember that the Fed, now they're going to manipulate money, they're going to manipulate the interest rates through the supply of money. But the actual monetary base isn't affected by the interest rates. Here's what is. That's why it's straight up and straight down. Because if the Fed automatically just says, we're going to print, or like you read in Naked Money, we're going to go ahead and press a button that now injects $1 trillion in the U.S. economy, that's just going to slide the supply of money to the right. That's all it's going to do. It's going to change this Q from, let's just make the numbers easy, from 2 trillion, then it's going to slide it over to the right to 3 trillion. That's all it's going to do. And this whole entire line goes from where it is right now, and it increases to the right. Okay, so that's what the Fed does when it presses that button, or it injects money into the economy. We're going to talk about how they do that, because they don't do it just through a helicopter dumping bags of money out. That'd be fun to watch, but that's not how they do it. What is affected by interest rates is the demand for money. Now this is M1 money. So this is the demand for actual cash. This is the demand for cash. So we're going to connect it to this graph, because that's what we do in macro. We connect graphs. All right, so there's your, you get to make the dot nice and big because I can't draw on this thing. There's your ag demand, ag supply graph at long run equilibrium. It's trucking along. All right, and then you've got the money supply graph at equilibrium as well. So there's the amount of money, there's the demand for money, and here's your interest rate. Okay, a couple of things that happen. First off, what's going to change the demand for money? There's going to be a couple of things that change the demand for money. Price level is going to have an effect on how much money people are demanding. Because think about it. As the price for stuff increases, are you going to need more money to pay for it or less money to pay for it? More, right? More money. You're going to need more money to pay for it. So your demand for that cash is going to increase. So as price level increases, the demand for money also increases, because you're going to need more cash to pay for it. How about this? As interest rates decrease, are you going to demand more money or less money? How many of you think that you're going to demand more money as interest rates decrease? How many of you think you're going to demand less money because interest rates decrease? How many of you think you're not going to demand that money demanded doesn't have anything to do with interest rates? How many of you are awake right now? Okay, you're going to go with the first one. So if you said that the demand for money increases as interest rates increase, you're wrong. If you said that the demand for money decreases as interest rates decrease, you're wrong. Because what's on your y-axis? What's the label on the money supply on the y-axis? Interest rates. Let's go back to supply and demand. Does price affect demand? No. It affects quantity demanded. It's the same with interest rates. So if your interest rates decrease, what happens for your demand for money? Say nothing. Nothing. Good. What happens for your quantity demanded of money as interest rates decrease? It decreases too, right? So as interest rates decline, right, to here, your quantity demanded of money increases. That's tricky. You're hurting my brain. No, it's not anything different than supply and demand. It's just instead of, remember, we started this whole thing out by saying, what was interest? And you guys correctly said it's the price of borrowing money. Okay? It's no different than this regular supply and demand. Don't abandon that. I told you guys, supply and demand is the foundation, and then we spent all of like a week on it. So, because in macro, we don't do as much just basic supply and demand. Micro, we're going to do a lot more. We actually spend a month on supply and demand in micro. In macro, we don't spend as much time on it, and that's partially a fault of how the class is designed. Okay? Again, don't forget simple basic supply and demand. Why does the demand for money increase? The quantity, demanded for money increase as interest rates decrease?
Because it costs less to borrow it.
Okay, it costs less to borrow it, that's good. That's one that you've got half the equation nailed right there. It costs less to borrow it, so you're going to borrow more money. What also is the case on the other side of the equation? Think of savers, yeah.
You don't get as much money back if you save it.
Good job. The opportunity cost for saving the money is higher. So let me kind of talk to you about what I'm saying, and then we're going to go back to our ag demand, ag supply graph. Okay, if you're a saver, someone who saves money, hence the name saver. All right, so if you're a saver and you're earning about 5% back on, let's say, we were talking M1 money on a checking account. Congratulations, you now live in the early 80s. You can grow a mullet and wear Canadian tuxedos everywhere and listen to this new band, Bon Jovi. All right, so you're a saver, you're earning 5% on your checking account. It's pretty good, especially if you're beating inflation. You're going to hold on that money in your checking account. Now something happens where interest rates decrease. We'll talk about what that something is a little bit later. Interest rates have now decreased. Now you're earning 2% back. Let's say inflation is 3%. What's happening to your money? It's becoming less what? Thought you had it. Starts with a V, rhymes with valuable. Good, valuable. All right, so it's becoming less valuable, right? Your purchasing power is diminishing. Okay, so you're sitting there and you're earning 2% back, and you're like, sweet, I'm earning 2% back on my checking account. Oh crap, inflation's 3. It's actually worth spending it, right? Because you're actually losing a percentage of purchasing power. Purchasing power, that reminds me of the Goonies, right? So you're actually earning less back purchasing power-wise. So the incentive to spend it is a lot higher. All right, so that's one issue. And then the other side, as Sam correctly identified, is it makes it a lot easier to borrow money. If you're going to buy a car, now's the time to do it. If the Fed starts creeping up interest rates, and we'll talk about how they do that, the price of a new car, if you've got to pay for it through loans, is going to become higher. Now, you may not be sticker-wise a lot higher, but as far as interest-wise, it's going to increase. So am I telling you to go out and spend all your money and go buy a new car? No. But if you're in the market for it, the incentive, that marginal benefit is going to tip up because your marginal cost, your marginal benefit is going to remain actually decreased because the benefit of saving the money is a lot less and your marginal cost is going to go higher because you're losing purchasing power. All right, so let's go to your ag demand, ag supply graph. Let's say that something happens where ag demand decreases. You got a decrease in ag demand. So you are now in what? A recessionary gap, right? You're now in a recession, or this area right here, Y1. Okay, you're in a recessionary time period. So, if you're King Fed, which I'll play on Friday, it's one of my favorite activities because I get to be King Fed. If you're King Fed, what's one way monetarily, or what's one thing you want to do to try to get back to long-run equilibrium? What do you want to incentivize people to do? Spend money, right? Now fiscally, right, there's a way that you can do that. If you're in a fiscal solution, you can either, what's the two things you can do if you're the president of Congress? Okay, you can increase government spending or you can decrease taxes. If you're the Federal Reserve, monetary-wise, you're going to have to incentivize people to spend. How do you incentivize people to spend money? We just covered it. Okay, you could, if you had control over prices, you could reduce prices. Or because you don't have control over prices, you would?
Reduce interest rate.
Good, reduce the interest rate. Now the Fed can't just snap its fingers and be like, we've reduced the interest rate, right? It can't do that. Not at least in textbook terms. So the Fed is going to have to do something in order to get the interest rate from I1 down to I2. What's a solution that you can see on the graph that they could do that?
Increase supply of money.
Good, increase the money supply. No, that's not what I want to know, go away. Okay, they're going to increase the money supply. Here's another thing you want to star and circle in your notes. I told you today was a big day because you were absolutely 100% going to get this on the FRQ and some FRQ, one of the three. And you're 100% going to get this in the multiple choice section. The Federal Reserve increases money supply, the supply of money, or the monetary base, if you want to be more specific. They increase the monetary base by buying bonds. Buying bonds. They increase the money supply by buying bonds. If you want to be more precise about that, they're buying government debt.
Pay no attention to what's on the screen, it's terrifying. For the kids that are helping out tonight, are we feeding them?
Yeah.
We are.
5 o'clock in the comments.
Okay. Some of my kids are at practice until 6, so,
That's fine, we'll try to grab some,
okay,
or might order pizza or something.
okay, gotcha, yeah, thank you. Awesome. I think I have like 5 kids too, so there should be quite a few.
No, a lot of lunch people.
Okay,
Yeah.
awesome.
Can you just talk through how that works?
Sure.
Just like.
Actually, hold on to that. If I don't address that question by 8:30, then make sure to ask that. Because we're gonna do T accounts through a bank. We're gonna talk specifically about that. Okay, so we'll talk about today how the government goes and buys securities. All right, so a couple things that I want you guys to be aware of when we're talking through this slide. Discard. All right, let's go. We're going to go backwards here and talk a little bit more. All right, so we're going to put this on pause and we're going to draw it all together here at the end. And we're going to talk more about T accounts. Can we do more T accounts? Yes, we can. I'm glad you asked that. All right. I asked that and I answered my own question because that's how I like to do things. If you guys have seen, what's that movie? My daughter watches it. Zootopia. And like that, the movie is kind of ridiculous all throughout it. And most of the time I just sit there and watch other things on my iPad. But the best advice in that movie is when the fox is talking to the rabbit about how to run a press conference. And it's like, ask your own question and then answer it. Like that's how I go about teaching. All right, so we're going to do T accounts because you can never get yourself wrong. Who wants to do more T accounts? No one. Oh, well, I guess I'm done teaching for the day, right? No, you answer your own question by like, I do. Okay, great. All right, so we're going to talk about a fictitious bank called First National Bank, which is probably, I need to change this because there actually is a First National Bank in Fort Collins. So I should probably change that. If your parents are the president of that, I'm not infringing on any kind of naming rights or anything like that. All right, so you decide to open your own bank because you have bags of money like Scrooge McDuck and you're just waiting to figure out a way to invest it. And after this class you realize banks can make a lot of money. Hopefully you realize that in the recollections from Pine Gulch. That Slim was making money hand over fist, right? All right, so
Is Slim dead
well, he's wanted, dead or alive. Another Bon Jovi reference right there. All right, so remember that on its basic T account, we've got assets and liabilities. Assets are what? Stuff you own. Good. Liabilities are? Stuff you owe. Good. Excellent. See, now you've just passed Accounting 101. You're now smarter than my younger brother. All right. So, you apply and receive a charter through the state. Yay, the state. Remember, who regulates commercial banks? The Federal Reserve, all right? But the state has to give you the okay to open a bank. It's actually illegal if you're running a bank out of your garage. Like, somebody comes to you and goes, like, can I borrow, $100? And you say, yeah, you can borrow that, and you make loans. It's called loan sharking, what you're doing, all right? Now, if you're doing it with your family and stuff like that, no. But if you, like, start a business and start charging interest and stuff like that, what you're doing is loan sharking, and you can get, like, I've got a guy who'll break your kneecaps if you don't pay back. Like, it's absolutely 100% illegal what you're doing. Again, if you're loaning money to family members and stuff, that's different. But if you built a business upon lending people money and they're paying money back to you with interest, if you don't have a state charter for it, you're loan sharking. All right, so you are going to do this legally so that you can make money above board. And so the state grants you your charter, allows you then to charge interest on money you loan out to strangers. And then you also get $5 million for capital investment in building and equipment. Yay, okay, you've got to actually have a building and equipment to do that. So your $5 million loan goes in your liability side. Okay, so that's the loan for equipment and your building. Okay, remember the three things from Accounting 101. Your asset side and your liability side have to equal out. Okay, we're not in accounting, we failed Accounting 101. Hopefully you're all nervous for some whatever reason. All right, so $5 million on the liability side, but who actually owns the plant and equipment? The bank does, right? You do. You bought it, didn't you? You took the loan and you bought that $5 million and that kind of stuff, right? Could your creditors come back and seize their assets and stuff like that? Yeah, but they have to go through all types of court orders and prove that they gave you the loan and blah, 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 blah. So you actually own the building and equipment, yeah.
So would the bank probably make a loan to itself?
It could if it had the money to. Yeah, it definitely could. So we're going to do this called plant and equipment. Because you actually own the building, and you own the vault and the ATM machine outside, and all the pens that people steal, and the envelopes, and all that kind of stuff. You own that as the bank owner. And yes, could your creditors come back and seize it, but you'd have to probably file for bankruptcy, and all that means is that you agree, like, sorry, bro, I know you loaned me $5 million, I can only pay like 60% of it back, and that's filing for bankruptcy. And then you can't buy a house for 7 years. All right, so you have $5 million that you actually own in actual physical stuff, the building, the pens, the vault, and all that. And you have the $5 million capital loan that you're going to have to pay back. That's how we get both sides to equal. The reason why I start with that is because on most T accounts that you see through College Board and the FRQs, they have something like that. Don't ever mess with these numbers. I haven't seen you want to talk about another mean thing that they could do in an FRQ. Say, all right, the bank pays back part of its loan, part of its initial capital investment. Say they paid $2 million back. What happens to this side in order to get it to equal out? Uh-oh. Okay, so you'd have to go through different ways, but they never make you mess with that. Because I can think of a way to phrase the question where you'd actually have to make the T account equal out. But it's kind of arduous. So the $5 million of the capital loan and the $5 million of the actual physical plant and equipment or the building and equipment you own, leave those alone. They're only there to make sure that both equal out. All right, so you run a campaign where you say, if you come and open a checking account with my bank, you get a shotgun, all right, as long as it's a $1,000 deposit. Sweet. All right, and if you're laughing because you're like, nobody's going to, there's all types of banks that run those types of promotions.
I would definitely do that.
So, yeah, I mean, if it's a good shotgun, that's what somebody in the other one asked. So, you run a promotion where, and banks used to do this, where they ran promotions where they would give away stuff. Usually it was like a toaster. I think one time I went into a bank and it was a grill, but it was like one of those like small little charcoal grill. It wasn't anything ever good, but it was trying to incentivize you to open it their bank instead of another one. Now banks do it more like free checking or free online banking or no fee ATM. So instead of giving away stuff, they actually do it through those other types of promotions. But let's say you're old school like that, and so you're going to give something away. So after the bank is open, people make $100 million in demand deposits. Look at you, you're rolling in it. Now that goes on the liability side, those demand deposits, because people are going to want their money back. Okay, I don't put money in my bank and to be like, I'm just going to leave it there, right? I use it constantly. And for, being a super rich teacher, I use more of it sometimes than I actually have, which means I get a very sad emoji face email from my bank. But I'm asking for, people are going to want their money back, so it goes on the liability side. But since both sides equal out, how do you get it to equal out? Initially, the bank has $100 million in what we call excess reserves. Now, in the margin, you might want to define what excess reserves are. Excess meaning extra. That's extra money. Now, extra money from what? That means it has to be left over from something, which is true. We're going to get there. But let's say there are going to be four things that banks do with their excess reserves. That doesn't really make it extra anymore. The first thing, there's something called reserve requirements. Reserve requirements. These are requirements that the Federal Reserve puts on banks that say you have to hold a certain percentage of your demand deposits in your vault. Okay, so reserve requirements, for those of you that are writing it down, that's smart. Reserve requirements is a percentage of your demand deposits that the Federal Reserve requires you to hold in your vault. Reserve requirements is a percentage on your demand deposits that the Federal Reserve requires that you hold in your vault. Now, in real world type things, the bank doesn't actually, you don't walk into your bank and go into the vault and get that money. They actually hold it on reserve at the Federal Reserve. So there's a branch in downtown Denver that they hold a lot of the bank reserves, actual cold hard M1 cash. They can also, again, if we're talking about like today, a lot of the stuff is done on computer. So they can hold it on like basically ones and zeros. A bank this size, the reserve requirement would be 10%. Meaning how much of that $100 million do they have to hold in required reserves? 10 million. Okay, so 10 million of that is required reserves. They can't loan that out. The bank cannot do anything other than just sit. It has to sit in the vault. Yes, ma'am?
So if on the test, let's say it was given that $200 million dollars were deposited, would we just change the excess reserves to $200 million no matter what you're?
So what you would do is you'd subtract out whatever the required reserves are. They'll give you. They'll say it's 10%.
It would give it to us?
Yeah, and it's almost always 10% because it's easy to work out.
Okay.
Because in that case it'd be 20 million, right?
Yeah.
So they'll say the required reserves is 10%, and then they'll go through and ask the question. So initially, once that the money is deposited in the bank, you immediately have to take out the required reserves. Okay, so that's money that cannot be loaned out. Okay, so that required reserves, that $10 million, has to stay at the bank. Meaning that now how much do they have in excess reserves? 90 million, tough math we're doing here. All right, 90 million. Okay, so the bank can now do three things with those excess reserves after the reserve requirement is taken out. They can loan it all out if they want. They can buy government securities if the Fed is offering that. Or they can just simply hold it in excess reserves. Do you think banks loan out most of their excess reserves? Yeah, they do, because they make money back on interest. Do you think banks buy government securities with some of those excess reserves?
Yes.
Yeah, they do, right? It's a safe investment. If they're loaning me money for my house, right, it's a somewhat riskier investment, even with like an extremely high credit score and good credit history. I'm going through a refinance right now. It's like a part-time job. And they want to know everything, where all the money is spent, where it's coming from, where it's going, and all that kind of stuff. They want to make sure I'm a safe investment. But they take a risk on me. Do they take a risk on government securities? No. Unless it's Zimbabwe or Madagascar, the answer is no, they don't. Okay, government debt is actually a pretty safe place because the government won't default on those loans, and if they did, it would be catastrophic. It would be the end of the world economy, especially as a country the size of the United States. A country as small as Greece, that has the GDP of a very small state here in the United States, they were talking about defaulting on their loans, and like the stock market tanked, people got really nervous. Because yes, they are part of the European Union, which is a much bigger, broader, economic powerhouse worldwide. But still, a small country like that can really affect the world economy. The United States, the biggest economy in the world, defaulting on their loans would be catastrophic. So everything would be done to prevent that. Plus, the government can always just print more money and pay off its debtors that way. We've talked about what a bad idea that is, though. Yeah.
Okay, so there's loans, so you can buy a house or whatever.
Yeah.
There's also investing in the companies and buying stocks in a company.
So that would be a loan out. So let's say, let's say Wells Fargo wanted to get in the stock market, which they do, and invest in certain companies, that's considered a loan.
Okay.
That would be
But
considered a loan.
we, as individuals, mere plebeians, can still do that.
Yeah.
Without having it being like illegal or anything.
No, you can
But
go
you
to.
can't do loans.
Oh yeah. You can't then get money from strangers. Now again, you can, but you have to be a licensed stockbroker. You can get people to invest with you, like Mr. Dixon does, invest with you, and then go buy stocks, and then you pay dividends or profits out to them. You can do that, but you have to be a licensed stockbroker to do it.
Okay. And you can also with some banks like Schwab, they say I want to invest this much,
Uh-huh.
this, and let's say like they might skim 2% off. Or
Yeah, sure.
2% higher.
Yeah, exactly. Yeah, and they could do that. Yeah, absolutely, because they're an investment house.
Okay.
So they're sort of regulated by the Fed. There's some of that. They're also regulated by the Securities and Exchange Commission. That's their main regulatory body that watches over them. But yeah, they could
Their
definitely do
reserve
that.
ratio probably is high because it's kind of
Yeah, well, it depends. If they operate as a bank that make out loans and you can deposit money in it, yeah, they do have a reserve ratio that they have to meet as well. Now we're kind of getting into fuzzy areas that I'm not 100% sure, but I do know that they have to hold some money back, and that part of them is regulated by the Fed. So absolutely. All right, so they've got now $90 million in excess reserves. So let's just say, just for ease sake and a way that we can kind of look at this, let's say that they make $80 million worth of loans. So that goes on the asset side. Meaning that they have $10 million left to buy government securities. So we're going to call these bonds right here, government bonds. So they've invested with people going and coming and getting loans, and they've also invested with government. They've bought government debt, so they've loaned the government money, $10 million in loans, and then there are agreements based on, remember, T-bills or treasury securities or bonds, depending on when their maturity date is and all that kind of stuff. And they're going to earn interest back on that. And like I said, they don't earn as high as interest as if they were to loan it to me for my house. However, I'm a riskier investment than the United States government. Even with all the debt, the US government still is a safer investment, or a safer risk than me. All right, so in comes the Fed. So we've talked about, is that the Justice Building or the Ministry of Truth? No, it's the St. Louis Federal Reserve. There it goes. It looks like what I imagined in 1984, what their buildings look like. If you haven't read 1984, you will, I know. But my favorite book, and I always imagine these big cement, yeah, all of the Federal Reserves look like this, like big cement buildings. Now we've talked about the reserve ratio. And we've talked about required reserves and excess reserves. We've talked about what banks do with those. They can hold on to them, they can loan them out, or they can buy government securities with it. So we've kind of all gone through that. All right, so we started today with the money supply. We're going to end today with the money supply, the monetary base. All right, so there are two types of interest rates that banks are involved with that are both Federal Reserve driven. And they're really confusing because they're the exact opposite of what you think they would be. Here's what I mean by that. Okay, there's something called the discount rate. That's the interest rate that banks are charged from borrowing money from the Federal Reserve. The discount rate is the interest rates banks are charged from borrowing from the Federal Reserve. Now you may or may not remember this. The Federal Reserve is known as the banker's bank, and it's also known as the lender of last resort. Banker's bank and lender of last resort. So banks will borrow from the Federal Reserve. Why would they do that? Okay, that's the lender of last resort. There was a run on the bank, absolutely. Okay, so that's one reason why they would borrow from the Fed, absolutely. Bank run, they can borrow that money from the Fed, they can pay it back, and then they'll pay back the Fed as loans start coming in and stuff like that. So yes, that's the lender of last resort. That's one big one. Yeah.
It could also be if their accountants were extra nervous and they realized they didn't have enough in their reserve ratio.
Excellent job. All right, two, they don't meet their reserve ratio. That happens quite a bit. Where they're loaning money out, they're doing that, and at the end of the day, they look at their books and like, oh, we're short. They don't want to get fined, so they can actually ask the Federal Reserve for a short-term loan. Usually it's just one evening. They meet their reserve ratio, perfect. They're in good shape. The next day comes, people start paying back those loans. They then pay back the Federal Reserve. Good. There's one other reason why they might borrow from the Fed. Yeah.
The interest rates are better for them than borrowing, like they can still make a profit off of investing.
Okay, good. So I'm going to go ahead, Montana.
I was going to say they don't want to carry all the cash, so they just borrow it from the Fed.
What do you mean?
So, like you said earlier, banks don't want to always hold their cash, so they store it in the Fed, so then when they need to withdraw actual cash, they can just take it from the Fed.
Okay, so you both are on the exact, I think you're on the same track. I'm going to take what you guys said and go with it a little bit further. Okay, if let's say you go into your bank and you say, I want to take out a loan, the bank doesn't have it, but they think you're a good person to loan the money to, where can they get that money? The Federal Reserve. So for making additional loans, right? That might be another reason why. So if they don't have the cash on hand, or they realize I can charge that person 3% interest, and the Fed is only charging me 1%. Sweet, I'm still making 2% interest. They can do that. The federal funds rate is the interest that banks charge one another for borrowing money. I know, I told you it's going to be kind of the opposite of what you might think. So the federal funds rate is what banks charge one another to borrow money. Why might, if you're a bank, would you borrow money from another bank? I'll give you a hint. It's the same reason you borrow from the Fed. Okay, you don't meet your reserve ratios, or you can still make money by loaning out money, or by loaning out money to other people. So your shotgun promotion works really well in your bank. And so much so that people are coming to you and want loans, and you're like, I have no more money to loan out. I've lent out all $80 million. And then you call up First Bank and you're like, I need some cash. Would you loan it to us? And we'll make that loan, and then we'll make the payment when we get paid back. And so they do that. Which one do you think is lower? The discount rate or the federal funds rate? How many of you think it's the discounted rate? How many of you think it's the federal funds rate? So the Fed wants banks to borrow with one another, meaning that which one is lower? The federal funds rate. So the federal funds rate is going to be lower than the discount rate. Here's where, if you're not confused enough, the only interest rate that the Fed can manipulate is the discount rate. Because remember, that's the interest they charge other banks. The Federal Reserve charges other banks. They can manipulate that. So yeah, I know, let me go back and do it slower, because I know this gets confusing. The only interest rate that the Federal Reserve can manipulate is the discounted rate. Directly, I should go back and say directly influence. The only interest rate that the Federal Reserve can directly influence is the discounted rate. Because the discounted rate is what?
The interest rate banks are charged for borrowing money from the Federal
Good,
Reserve.
because it's the interest rate that banks are charged from borrowing from the Fed. So they can directly manipulate that. They can be like, it's going to cost you 1% to borrow from us, right? They can set that. All right, so they can't directly influence the federal funds rate. However, the federal funds rate is influenced by the discounted rates. So when the discount rate goes down, what happens to the federal funds rate? It goes down too.
I have a question.
Yeah.
Do banks ever, might be illegal, work together, like First Bank and Wells Fargo, hey, we're making a lot of nice fake accounts right now, can we have some money, and next time we'll scratch each other's back type thing?
So they can't collude and just be like, hey, we're only going to lend to you and you can only lend to us and stuff like that.
They can't do that.
They can't collude, no. But they will, because you're just going to go, banks are no different than a regular consumer. They're going to go to the person that's going to offer them the lowest interest rate to borrow that money, and it's set indirectly by the discounted rate anyways.
And if this happens on a daily, like in the evening?
Oh, it happens all the time, yeah.
So does that mean interest rates will go up and down even for that on that day?
They can flex, absolutely. You'll learn this when you buy a house. When you agree with your mortgage lender, you lock in your interest rate. That way it won't bounce around on you. Yeah.
What happens if one bank gets like ostracized and no other banks belong to them? They just, like,
Yeah, I mean, that can happen. But again, if the bank is offering such a good interest rate, people will go to them. Just because, again, banks are no different than consumers. It's like saying, what happens if Walmart kind of gets ostracized? Well, if Walmart's prices are low, people are going to go to them anyway. All right, so we're going to talk a little bit more about this. Sam, I don't know that I answered your question. How exactly does the Fed sell securities? We'll talk about that tomorrow. All right, see you guys. Have a good day.